Welcome back to Investing Talk Podcast. Retail chatter has been, well, absolutely deafening lately, hasn't it? But we are cutting through all that market noise today. We're focusing on one of the really interesting players in this sector, Dollar Tree. And we want to answer a pretty straightforward question for you, the listener. Is Dollar Tree a good time to buy right now? We've gone through a massive stack of sources, fundamental reports, technical charts, operational timelines, and we've tried to synthesize the key nuggets just for you. Before we unpack all that, please make sure you subscribe, like, and comment. It really helps us out. And hey, if there's a company you want us to look into in a future analysis, just drop that name down in the comments below. We do read them.
Absolutely. And our mission today really is clarity. What our research seems to suggest is that Dollar Tree is sitting at a real inflection point. I mean, on one hand, you see very strong underlying top-line growth. It's quite impressive. But on the other hand, you've got some clear profitability headwinds that, well, the market seems to be struggling to reconcile. Plus, they've just signaled massive management confidence with a huge buyback authorization. And this is all happening while they're preparing for a calendar that looks packed with strategic catalysts. So, yeah, we're going to try and pull apart that tension for you.
Okay, let's use that tension as our guide then.
Yeah.
Starting with the fundamentals. That top-line performance, as you said, it's been truly phenomenal. Our sources highlighted a tremendous 12.3% increase in revenue in the comparable quarter last year. That's significantly outpacing key competitors. That's not just growth, that's really winning market share, which is absolutely crucial in discount retail, right?
Oh, completely. That volume is undeniably impressive. But here's the rub, and this is where the conversation gets a bit mixed. Profitability. So while they're ringing up tremendous sales, they seem to be struggling currently to convert that into bottom-line profit. The analyst community is clearly divided on this, mainly because the sources reported a negative net margin.
A negative net margin. That is the ultimate head-scratcher. I mean, they're moving product hand over fist, but somehow they're spending more than they're earning on that net profit line.
Right.
Why is that margin negative right now? Is this like a systemic issue or maybe just a temporary operational cost thing?
Well, the current read points towards significant, perhaps non-recurring or integration-related costs. We are seeing elevated freight and fulfillment expenses, which, have been a burden across the entire retail sector. But critically for Dollar Tree, a lot of this pressure seems to stem from integrating their strategic shifts. Things like expanding distribution capacity and handling the higher costs that come with moving beyond that traditional $1 price point. They're investing heavily in the future, right? And that investment seems to be eating the profit right now. You could think of it this way. Maybe for every dollar they earn right now, they might be spending, say, $1.5 to deliver that value. That leak, well, it has to be fixed.
Okay, that context is absolutely vital. So the question becomes, can their balance sheet actually handle these growing pains while they fix that leak? Debt always gives me pause, especially when a company's in an aggressive expansion phase like this.
Yeah, that's fair. But the good news here is the balance sheet looks, well, steady enough to weather this growth push. Their debt-to-equity ratio is sitting at a moderate 0.67, roughly. What's truly fascinating, though, and maybe speaks volumes, is the massive vote of confidence from the board, even in the face of these margin issues. They authorized a $2.5 billion share repurchase program.
Wow, $2.5 billion. That's substantial. So that authorization allows them to buy back up to, what, 11.5% of their stock? But let's be a bit cynical for a second. If the profit margins are shaky, isn't spending that much capital on a buyback maybe a risky move? Or is management just betting that profitability is about to dramatically turn around because of those investments they're making?
It really seems like the latter. The sources strongly suggest this massive buyback signals that leadership believes the stock is deeply undervalued right now and that the current margin pressure is transient, temporary. I mean, when a board is willing to use that much capital to retire stock, they're effectively saying, look, we see the path to higher profitability and we're willing to double down on our own equity. That said, we can't just ignore the small print, can we? The research did flag that their liquidity metric is only slightly above the required threshold for short-term stability. So while they seem to be managing risks effectively, that liquidity number is definitely one metric to keep a close watch on going forward.
Yeah, that liquidity threshold is exactly what separates, a minor risk from a major red flag in a capital-intensive sector like retail. Okay, shifting gears a bit, let's see what the market thinks of this complex financial picture. Let's look at the technical indicators and their competitive stance. I mean, Dollar Tree maintains a truly dominant position in the dollar store sector. It's backed by real brand strength and incredibly loyal customer traffic.
Absolutely. Their category leadership gives them a competitive moat that, frankly, most retailers would envy. Now, looking at the price action itself, the stock is currently trading around $87.68. And if we connect this to the broader picture of analyst sentiment, the expectations for appreciation are, well, pretty significant. We're talking about analysts predicting an upside ranging anywhere from 18% to potentially over 29% from this current level.
Hold on, 18 to 29%. That's a massive range and a big potential jump. What exactly are those analysts seeing through the fog that gives them that much confidence in the short term?
Well, it appears they're looking past the short-term margin dip. They seem focused on the operational improvements coming down the pike and the expected trading range. For the next 3 months, the anticipated ranges sit between, say, $95 and $115. That really speaks to a very bullish outlook, likely driven by expected Q4 performance and those operational fixes starting to take hold.
Okay, let's get a bit more granular on momentum then. Are we looking at overbought territory here, or is the stock kind of sitting on a technical launch pad?
It feels more like it's coiled right now. The Relative Strength Index, the RSI, which basically measures the speed and change of price movements, is sitting at 43.54. That means momentum is pretty neutral. There's no immediate pressure from overheating buyers or, panicked sellers. Technically, though, we do see a crucial signal. The stock is currently trading below its 50-day simple moving average, or SMA. That's at $105.71. And that typically indicates some short-term weakness.
Okay. But I assume there's a major silver lining on the longer-term charts, perhaps.
Precisely. It's holding very close to its 200-day SMA, which is currently around $87.81. Now, the 200-day SMA is essentially the stock's average price over the last 40 weeks or so, and it often acts as this long-term bedrock of support. The fact that the price is kind of hugging that long-term support line suggests the market sees sustained long-term value here, preventing a major breakdown. It's basically consolidating near a major support level, which is exactly what a bullish investor often wants to see right before potential catalysts hit.
All right, speaking of catalysts, let's talk operational moves over the past 3 months, because this seems to be where management is directly addressing that profitability conflict we talked about. That Q3 earnings surprise back on September 3rd. That was a powerful proof point, wasn't it?
Oh, it was a game changer, really. Dollar Tree reported earnings per share of $0.77, which impressively beat the consensus estimate by $0.39, a huge beat. And that beat wasn't just luck. It really showed management was executing effective cost management, at least relative to what the market expected, and it reinforced that strong top-line momentum we mentioned earlier.
But the real long-term fix, presumably for that high cost of goods and fulfillment burden, is the massive strategic infrastructure investment they're making. These aren't just minor store remodels we're talking about.
No, absolutely not. These are, you could say, generational investments in their supply chain. They announced a brand new 1.25 million square foot distribution center out in Arizona, set to open in spring in 2026. And this isn't just a warehouse, it's like building high-speed rail for their supply chain. It should drastically enhance their reach across the Southwest. And they have plans for another major facility in Oklahoma coming in 2027. These huge capital projects are designed specifically to drive down those fulfillment costs and speed up inventory turnover. That's the ultimate way they tackle that negative net margin issue long term.
Okay, so when you look at those positive operational steps, it's pretty clear why institutional sentiment might be starting to warm up. We saw increased institutional ownership and analyst upgrades from major firms like JP Morgan and Barclays right after that strong earnings report.
Exactly. That's the consensus reacting to the positive operational story unfolding. However, and there's always a however, it seems, we have to address the conflicting signal. There has been some insider selling activity noted. Specifically, one director reduced their stake by a noticeable 22.47% in early September.
Why would a director sell off a significant chunk of their stake right as the company is posting strong beats and announcing these massive future-focused infrastructure investments? That seems counterintuitive.
It does cause a bit of confusion, doesn't it? I mean, it could simply be portfolio rebalancing for personal reasons, or it may be just cashing out after a price run up earlier. We don't know for sure. But yeah, when institutional buyers are apparently flooding in and insiders are stepping out, it definitely highlights a potential divide in internal confidence or maybe just timing perspectives. It's a necessary caution signal, I think, even if the broader long-term narrative remains strong.
Okay, fair enough. Let's look ahead then. For someone listening who might be considering leveraging the shorter-term opportunities, what events over the next say, 3 months should they really be keyed into?
Right. We have about 4 major potential triggers identified in the research. First, late October brings the major ETF quarterly rebalancing. That can drive temporary but sometimes intense institutional flows in or out of the stock. Then, mid-November, we should get the preliminary holiday traffic and income report. This is always a critical early indicator of consumer strength heading into the crucial Q4 period, absolutely essential for any retailer like Dollar Tree.
And a really big one is scheduled for December, right? The earnings report.
Absolutely. The biggest potential catalyst will likely be the Q4 earnings release, which is scheduled for December 18th. This report is expected to show strong year-over-year growth. And any significant beat here, especially if it shows early signs of margin stabilization, thanks to those operational efficiencies kicking in, will likely act as a major trigger for upside momentum. And finally, looking into January, we should probably see some distribution center updates, which would give us a check on the operational progress of these massive new facilities they're building.
Okay, so combining the risks with the potential rewards, let's just summarize those remaining financial risks one last time, to be clear.
Sure, the company-specific risks are pretty well known now. The debt levels seem manageable, but definitely require ongoing monitoring, and we need to keep an eye on that somewhat tight liquidity metric we mentioned. Sector risks, like the broader, challenging retail environment, they're always present. But Dollar Tree's strong fundamentals and brand dominance seem to position it for resilience, perhaps better than some peers.
Got it. Now let's indulge a bit in the industry chatter that was mentioned in the research. What's the speculative buzz, the whispers around Dollar Tree right now?
Okay, so there are basically 3 main whispers floating around. The first is ongoing rumors of potential private equity interest. This suggests Dollar Tree could become an acquisition target or maybe even attract activist investors. I mean, that massive share buyback, combined with the stock trading near its long-term support level, could certainly make it look appealing to activists looking to unlock value.
Interesting. And what about their famous pricing model? They built their brand on that dollar price point. Are they really moving significantly beyond it?
Well, there's intense speculation about more aggressive pricing adjustments, moving well beyond that traditional $1 and 80-cent range they've expanded into. This would likely be a strategic move to capture different, maybe inflation-driven demand segments and, crucially, improve those margins we talked about. And lastly, we're hearing faint hints, just whispers really, of potential partnerships, maybe with specialized logistics firms for optimizing last-mile delivery, or perhaps fintech firms to integrate new payment technology and smooth out the checkout process.
Okay, fascinating stuff. So bringing it all together then, fundamentals show rapid growth, but it's currently throttled by those market issues. Though the fix, these huge DCs, is literally being built right now in Arizona and Oklahoma. Technicals look neutral-ish, but resting on powerful long-term support, with analysts predicting potentially massive upside. And we have a clear timeline of short-term catalysts coming up. What's the final investment thesis and horizon here?
Based on the synthesis of all this data, the overall rating comes out as a bullish 8 out of 10. The rationale is pretty straightforward. You have strong revenue momentum, you have anticipated earnings acceleration as those operational efficiencies hopefully kick in, and you have its continuing competitive dominance in a pretty recession-resilient retail sector.
Okay, an 8 out of 10. And for the listener who might be considering an entry right now, what's the best investment horizon to think about to maximize this potential?
Short term, long term, both.
It really seems like the stock offers a kind of dual opportunity right now. It appears attractive for shorter-term trading, maybe trying to leverage those specific volatility catalysts coming up in the next quarter, especially that December earnings report. But it also looks equally compelling, arguably, as a longer-term investment, aiming to capture that structural growth potential and the eventual long-term margin benefit from these new massive operational expansions once they're fully online. Great summary. So to quickly reiterate the key takeaways for everyone, operational expansion is robust and underway. That $2.5 billion buyback program is a huge signal of internal confidence. And that Q4 earnings release in December looks set to be the major near-term trigger that could potentially launch the price into that higher trading range analysts are forecasting.
Exactly. And this really raises an important final question for you, the listener, to think about. Given some of that speculative chatter around potential leadership changes and maybe board realignment, what the research called ongoing governance evolution, how might that management dynamic impact the actual execution of these large, bold, strategic investments, like those crucial new distribution centers that Dollar Tree just announced? That governance stability or lack thereof will be really critical to watch as these massive operational projects move forward over the next couple of years. Something to keep in mind.